Good morning, students. Welcome back to this session on Ind AS. So today we are going to continue with financial instruments. In the last session, we started with certain basic things about the financial instruments. We discussed majorly about the definitions of financial asset, financial liability, equity, and we also understood as to what can be a financial instrument. Then we also moved on to the classification of financial assets because classification drives the measurement of the financial assets. And this measurement is something that we are discussing in terms of the subsequent recognition, or you can say subsequent measurement. Because at the time of initial recognition, every financial instrument has to be measured at fair value. Yeah. And I'm hoping that you would have been revising all of these things that we have been discussing, and you would have practiced certain questions around it from the study material. Couple of questions I also keep for the homework. Yeah, so with that part as the understanding, we can do a just quick recap of the classification of the financial assets. And you can also just let me know in terms of your understanding of the classification of financial assets while we do this recap. So can you tell me broadly as to what are the categories for the financial assets and how do we decide that categorization? Yeah, so I'll just wait for your response and I'll also start on this discussion in the meantime. We have three categories for the financial assets: amortized cost, fair value through OCI, fair value through P&L. For the amortized cost, we discussed that certain conditions are required to be fulfilled. What are those conditions? We look at the business model, which should be hold to collect. And when we say hold to collect, that means the financial asset should not be sold. It should be held by the entity till the time it is mature, or till the time the agreement around that financial asset is not yet completed. Because we all understand that any financial instrument and therefore any financial asset will be driven by a contract necessarily. So there has to be a contract. Number two, there should be contractual cash flows which will get collected at the time of maturity. And these contractual cash flows should be limited to SPPI. Yeah, what was SPPI? Solely payment of principal and or interest. So if we have these two criteria fulfilled, then we can say that financial asset will be measured at amortized cost subsequently. Yeah. And in terms of these two conditions, we will say when only these two conditions are fulfilled, then the financial asset will be measured at amortized cost. And why I'm saying only these two conditions? Because if we include one more criteria in this, that means along with hold to collect, entity will also be selling certain financial assets, or entity is selling certain financial assets. So it's doing mix of both, holding some and selling some. And whatever is held, that is collected, wherein the collection is limited to SPPI. In such a case, instead of amortized cost, such financial assets will be categorized at fair value through OCI. Yeah, such financial assets will be categorized at fair value through OCI. Okay. Then the third category was the residual category. Residual category means any asset, any financial asset which will neither fall under amortized cost nor under fair value through OCI will automatically go to fair value through P&L. And for this fair value through P&L, therefore we can say a couple of conditions can be considered. First, either the SPPI fails or entity is holding all the financial assets for the purposes of sale only. That means they are not holding the financial assets for generating contractual cash flows and waiting till maturity. Yeah. So these are the three criterias which can be considered in relation to fair value through P&L. And these are the buckets. On the basis of these bucketing, then we discuss that financial assets which are measured at amortized cost will have a different accounting treatment as compared to other two buckets, because for other two buckets, fair valuation will be done at every subsequent date. With the difference that in case of fair value through OCI, the changes in fair value will go to OCI, and in case of fair value through P&L, the changes in fair value will go to P&L. Yeah, correct. So these are broadly some of the things that we discussed about the classification of financial assets. And today we need to get into details of all of these classifications once again. And you may be thinking, sir, we have understood the classification. Then why do we need to get into detail? Because these are broadly the concepts that we have discussed. So we have not got into the finer details around it. So finer details are yet to be discussed as to what can be a business model, what all points we need to consider for the purposes of business model, what all things we need to consider in detail around the contractual cash flows, in detail around the SPPI, etc. Yeah, and if we also practice certain questions around it, that is how we'll be understanding all of these concepts, and then we can say that yes, we are ready for the classification of any financial asset into any of these categories. And then we'll move on to the accounting requirements for such financial assets. Okay, yeah, so that's the plan we have for today. Now, before we get on to this, can you just quickly confirm, because I have not received any response from your side on this classification of financial assets as yet. So I'm just hoping that you will still be sharing certain responses. Can you please confirm quickly whether you have completed the homework? Yes, quickly. I have not discussed the definition of financial assets, financial liabilities, etc., because I'm hoping that you would be knowing that part. So that's why we should not be getting into that again. Quickly, can you please confirm about the homework? And now you can also get into one illustration before we get into our further discussion. Let me just see whether you remember all of the points that we discussed in the last session or not. I'm still waiting for your confirmation on the homework, please. Yeah. And in the meantime, you can just start with one illustration. So you can just get onto the study material, page number 12.11, illustration number 5. Okay. Yeah. So all based on whatever we discussed in the last session. All of you, yeah, you're ready, you're there. Okay, perfect. So Vaibhavi has confirmed she has completed the homework. I'm hoping others are also responding fast. Great. So let's get on to the illustration now. Illustration number 5. A Limited makes a borrowing for rupees 10 lakhs from RBC Bank with bullet repayment of 10 lakhs and annual interest rate of 12% per annum. So A Limited has taken a loan of 10 lakhs. Interest rate is 12% per annum. Yeah. Now the company defaults at the end of 5th year, and consequently rescheduling of the payment schedule is made beginning 6th year onwards. So now this loan which was required to be paid could not get repaid at the end of the 5th year, and therefore rescheduling has been done. Rescheduling means if the payment has not been made on time, maybe both the parties have discussed and sort of rescheduled the repayment plan. The company, with this rescheduling, will be required to pay 13 lakhs at the end of 6th year for one-time settlement in lieu of defaults in payments made earlier. Okay. So there will be one-time settlement equivalent to 13 lakhs. So this one-time settlement is for the defaults. First question that you need to answer, and I want all of you to please attempt this on your own. This is very, very simple and based on whatever we have discussed. Does the above instrument, means this instrument that we have been discussing in relation to A Limited, meet the definition of a financial liability? You need to explain with reasons. First of all, Pujita has also confirmed that she has completed the homework, and I'm hoping now all of you will start sharing your responses. Yes, quickly. Tell me first of all about this instrument. Now please understand that this instrument has had certain defaults. So considering defaults, etc., all of these things, you need to tell me whether this instrument will be classified as a financial liability or not, or will you call it as equity or maybe a financial asset? Because I think these are the three things we have discussed, so it can be limited to any of these three. So waiting for a response quickly, and you need to give the reason why you want this to be classified into a particular category. Chavi has also confirmed the homework status. Very good. And can you please start sharing your responses on this? About this instrument, whether this will be a financial liability, equity, financial asset, or what do you call it as? Or maybe something else. Yeah. So it can be any of these. Kaustav has answered. Very good. Kaustav is saying it's a financial liability because there's a contractual obligation to deliver cash. Okay, and I'm just hoping some other responses. Okay, great. So Chavi has also responded. Chavi is saying there's a contractual obligation to pay cash in this instrument. That's why it will be a financial liability. So let's understand this instrument at the beginning. So we are forgetting something which has happened during the contract period. We are again ignoring any of the aspects which could be in the form of defaults. At the time of beginning, entity A Limited will be required to pay cash. Yeah, because A Limited will be required to pay cash, and that is arising through a contract. That's why, what do we call this instrument as? This will be called as a financial liability for sure. Yeah. Now we move on to question number 2. That means the second part. Analyze the differential amount to be exchanged for one-time settlement. Now, this one-time settlement which is required to be done. Okay, this one-time settlement which is required to be done, we need to analyze this aspect of the instrument. How do we deal with this? Or what do we call it as? How do we treat it? How do we recognize it? How do we measure it? Yeah. So there are a lot of questions I have asked you. And the only thing that you need to answer is, please provide brief explanation around it. On this part number B, you need to tell me how would you deal with this. Bhargav and Neha have also responded for the first part. Great. So now for this part number B, I'm waiting for a response. For part number B, what do you think? How will this be treated? How will this part be treated? Rohit has responded. Yes, for part number B, quickly, How would you deal with this part number B? What do you call it as? Just go back to the discussions that we have had in terms of financial liability. I'm sure you will get the answer. In terms of financial liability, if you remember the definition, you will just understand how should this be treated. Quickly. Yeah, you need to answer this quickly, please. Okay, great. So I've received this detailed response from Pujita. I'll just read out for you. So Pujita is saying this instrument has to be a financial liability. Initially, there's an unfavorable condition of payment of amount of 13 lakh. And I'm not sure why this is unfavorable. So let's read through. And the interest is being unpaid during the contract period. The difference between the actual amount payable and 13 lakhs will be the extra cash that will be paid, which is an obligation, hence again a financial liability. Okay. Now in this case, though Pujita has touched upon the aspect of unfavorable condition which is attached to this, and something which becomes sort of unfavorable with those aspects that we have discussed in the context of financial liability, yeah, will be required to be considered over here. So let's understand what is the impact in this case. Now in this case, if we look at the liability portion, what's the liability portion? 10 lakhs. Now at the end of 5th year, there has been a default. At the end of 5th year, there has been a default. So what's the default? It's the interest payment which has been defaulted. So we can say into 1.12. Why are we doing this 1.12? Because we are saying this amount plus 12% interest on this, correct? But this has got settled. So when this got settled, so at the beginning of the 6th year, this got settled. And let's see how this has been settled. Up to 4th year, everything was okay. 5th year end, there is a default. Okay, end. So I'm saying end of year number 5. There's been a default. So at the end of this year, 10 lakh, yeah, was the principal amount, and 12% should have been the interest amount. So my total liability at the end of 5th year becomes 10 lakh into 1.12. Correct? Now, if you look at the contractual period, this is now getting fully settled with one-time settlement equivalent to 13 lakh. And when is that happening? 6th year. 13 lakhs is the full and final payment which is getting paid. But at the end of 6th year, even if this interest is not paid, interest for another year has to be accrued. That will become payable. Yeah, because if the payment is not made at end of year number 5, then the amount which is outstanding. And what is the amount which is outstanding? This is the total amount which is outstanding at the end of year number 5. Okay. If this amount would have been paid at the beginning of 6th year, then no further interest was required to be accrued. But because one more year has lapsed, one more year has gone by, so that's why again on this outstanding amount we need to accrue interest. So what do we do? On this amount we will take up 12% interest and we will include this amount. So this amount plus 12% interest. So what do we get? So we get 12,5400. Sorry, 12,54,400. So this gives us 12,54,400. And all of you, please confirm this computation quickly to me. Yeah. Now, if we look at this situation, amount which was required to be paid was 12,54,400 if we go by the terms of the contract. But actually, the amount paid has been higher. So if we pay a higher amount than the contractual amount, so what does it become? Unfavorable. Yeah, and this portion which is unfavorable, that will again become a financial liability. Correct? Yeah. So the difference, therefore, between these two is again what? That is also a financial liability. Clear on this aspect? Yeah, all of you? Do I receive this response from Bhargav also in the meantime? He's saying out of 3 lakhs, 180 pertains to excess amount paid due to default. So I'm not sure about the computation though. Yeah, but he's saying the concept of SPPI is missing. Hence, it should be treated under fair value through OCI. So I would again tell you one thing, because I remember that we had this discussion in the last session also, that in this topic, there are great chances that you can mix up 2 aspects. I'm just repeating because I can see this clearly from the response I've just received. One is a holder and second is issuer. This is the biggest problem you may face in this topic. And I can see a lot of your responses are reflecting that you are mixing up these two. Now, if I look at the response which I have received, so it says it's missing the concept of SPPI. Yeah. Can you tell me where did we discuss the concept of SPPI? We discussed the concept of SPPI for financial assets. Did we discuss the concept of SPPI for financial liability? Not yet. For financial liability, we have only discussed its definition. We have not gone beyond definition. Correct? We have not gone beyond definition. That means if you are responding for financial liability, we all understand it's a financial liability. Part A clarified this aspect. Correct? And we also understood that this differential is also a financial liability. So all in all, this total amount is nothing but a financial liability. So the moment we understand it's a financial liability, we should be very clear. What? That we are looking at the perspective of issuer. Because for a holder, is this possible that this instrument will become a financial liability? Or forget this instrument. For a holder, is it possible that any instrument will become a financial liability? Not at all. Please understand, what do we mean by a holder? Holder means somebody who holds an asset. Somebody who holds an asset. So when you hold an asset, what will it become? Can we say it will become a financial liability? No. Because this is an asset. That's why it can either become financial asset or non-financial asset. Is it ever possible for that instrument to become financial liability? Never. Yeah. So that's why, again, something which bothers me right now is that you are mixing up these two. So you should forget SPPI completely in this case, because SPPI is something that we have discussed in the context of financial assets. Okay. All of you clear on this part? Yeah. Clear that this is a financial liability for which we have not discussed anything about SPPI. So till the time we don't discuss anything about financial liability in relation to SPPI, you should assume by default that SPPI is only meant for financial assets, and actually SPPI is only for the financial assets. So SPPI concept is not there for a financial liability. Clear on this aspect? Yeah, I'm hoping you are clear on this now. Okay, and therefore once again, Like the response said, it should be treated under fair value through OCI. Again, it's a big mix up. When we are saying that it's not a financial asset and there's no correlation of this portion with financial asset, so that's why that categorization is not required to be done. Why? Because for a financial liability, we have not discussed the categorization at all. Even if we talk about that categorization is not in line with the categorization of financial assets. Two are different. The categorization of financial liabilities are different as compared to financial assets. Okay, all of you now clear on this part? Kaustav is asking, sir, why we have taken the interest for 1 year only? That means 5th year only. Why we have not taken for year number 1 to 4? Because we have assumed that year number 1 to 4 are paid. That's why we have not taken it. Okay? Yeah. Yeah. And I'm hoping that all of you, Bhargav is now very clear, but I'm hoping that many of you would be having this confusion. But you may not have discussed or you may not have shared your responses with me. Yeah. So that's why please remember that you need to be very, very clear while answering. Whether it's holder or issuer, or where is the holder possible, where is the issuer possible. Okay, yeah. These type of questions, for example, illustration number 5 or any of the other questions wherein you get stuck or wherever you feel any sort of problem while answering, you should make it a habit that in your notes, you should mark that illustration for practice. Because while you will go through the notes later on for the purposes of your revision, you will be able to revise the concept. But some of the challenges which you might have been facing now, you may forget. And those challenges will then automatically come at the time of examination. So that's why to avoid that situation, what should you do? You should make sure that before the exam, when you are revising all of these concepts, you are also practicing some of these complicated questions for you. And something which is complicated for one student may not be complicated for other. Yeah. So that's why I'm saying this is completely on to you. Which one do you mark for your want to mark for yourself and which one you don't want to mark. Okay. Clear? Okay, perfect. So now we can just move further. So I need to share the presentation with you now. So this is the aspect that we have been discussing. So let's get on to the SPPI first of all. And you can just look at some of these points on the screen also. Contractual cash flows that are SPPI should be consistent with basic lending arrangement. I'll come to this basic lending arrangement. First of all, let's understand what do we include in SPPI. In SPPI, two things are included. Principal, which is very basic to understand. So what's the principal? It's the fair value of financial asset at initial recognition. Principal amount may change over the life of the financial asset. For example, if there are repayments of the principal, right? But principal is easy part for us to understand. So we are not getting into too much details around the principal. I think the most important aspect in SPPI happens to be interest. And this will be the most important aspect for you to analyze financial asset at every point of time. Because whenever you will get questions, in those questions, the only thing which will trouble you or the only reason why you should get into the detail to understand as to whether an instrument or that asset may or may not be having this component of SPPI only could be from the context of interest. So let's understand how. Interest element should be consistent with basic lending arrangement. So that means when we are receiving interest, this interest should be limited to what we get as an interest in case of any normal borrowing. And this normal borrowing has been explained with certain technical terms around it, which has been called as basic lending arrangement. So what do we mean by basic lending arrangement? So that means if we take any normal loan, I'm just using this word loan normal. If we take the loan in the normal course of business, so the interest that we may have to pay or the interest that we may charge when we give a loan, that interest is something which will be included in this SPPI. So in this SPPI, this I, which stands for interest, should only include the interest which is under the basic lending arrangement. And there could be certain portions of this interest under basic lending arrangement. Let's understand what could those portions be. First, I think this is as simple as that. The moment you get an answer to this question, automatically you'll start understanding the perspective or the details of interest. One, we want to cover the time value of money. So for covering the time value of money, we charge interest. Let's understand again why. Say for example, we have 1,000 rupees today. So I have 1,000 rupees with me available. Now, if I keep this 1,000 rupees with me for 5 years, that means I have not spent this money. So this money is with me. So what will I do? I can just invest this money, say in the form of a bank deposit or say for any other purposes. And if I invest this, then I'll get return on this over a period of 5 years. That return will change my value of 1,000 to something which is more than 1,000 after the end of 5 years. Yeah. So that will change the value from 1,000 to something more. Let's understand what will that value become. So today I have got 1,000 and after 5 years, this will become 1,000 plus. Say for example, it becomes 100 rupees. So 1,000 plus 100, it becomes 1,100. I'm just taking it as an example. Don't get into the computations. Now this value that we have today, 1,000, what do we call it as? Present value. Present value means value as on the date, value on today's date, value in present times. And what is this value? This value is something which will come in the future. So this is called as future value. Some of you may be knowing this concept and some of you may not be knowing this concept. But please remember that this concept is extremely important under financial instruments. In fact, under Ind AS, this concept that we have been discussing now is extremely important. So if you have any questions under this concept, even if you believe this concept is very, very simple, please ask me. Because this will be comprehensively used throughout Ind AS. Forget Ind AS 109 only, or forget only financial instruments. This will be used throughout Ind AS. Okay. Now, let's understand why will this 1,000 become 1,100? Because we have invested our money. So we will say that we will not keep our money idle. We will keep investing it. And when we'll keep investing it, we'll keep getting some return. Now this return of 100 can also be equivalent to 300. sorry, instead of 100, this can be 300. Yeah. Again, because this was an example, so I can have another example of 300. Correct? Now the question arises that what's the difference between this 100 and 300? If we give our 1,000 rupees to somebody as a loan, that means this is A Limited and A Limited has given this as a loan to B Limited. Now B Limited will consider this as a borrowing and A Limited has also given a loan to B Limited. That's why what A Limited will charge from B Limited is the value of this 1,000, or you can say the value for keeping this 1,000 and utilizing this 1,000 for a period of 5 years. And let's understand why will A Limited charge this. One, there's a time value of money. This money has got time value. That's why A Limited is saying, please pay me something in relation to that time value. Number one. Number two, this B Limited is not a relative of A. Correct? Even if it's a relative of A, these two are separate persons, separate legal entities. Correct? These two are separate persons, separate legal entities. Therefore, it's important for A Limited to analyze the risk which is involved while dealing with B Limited. And let's understand what can be the risk. Maybe after taking this loan from A Limited, B Limited refuses to make the payment. That means there could be a risk of default. But who is bearing that risk? A is having that risk. That risk is on A. That risk is not on B. Now for bearing this risk, A would want some return. Yeah, you all understand this concept. Return is always attached with the risk. The more the risk, the more and more the better the return. That's why, other than time value of money, what do we say? We will say that there are certain risks which are attached with it, for which A would want to charge something. So this 100 will include one component which is time value of money, another component which is in relation to the risk. Another risk which could be attached will be in the form of liquidity risk. If A would have kept this 1,000 with itself instead of giving it to B Limited, A would have more liquidity. Correct? Or say, instead of giving this to B Limited, let's suppose if A Limited will give it to somebody else, wherein this amount is more liquid as compared to what it is now. So again, a risk is attached, and what is that risk called as? Again, that is considered to be a liquidity risk. Now for again bearing this different type of risk, will A Limited want something in return or not? Yes. And what will that return become? Again, a part of this rupees 100. So there are three things that we have discussed. Correct? Fourth, it could also be the business of A Limited to give loans of these types to various parties. For example, A Limited may be a bank, A Limited may be any financial institution, A Limited may be an NBFC. So they have this business. What's their business? To give loans. To give loans for a certain period of time and then receive that back from those parties. By doing this, what do they want to do? They will definitely want to have time value of money. They would want to cover the return for the risks which are attached, but they would also want something in the form of a profit element. Yes or no? Something in the form of a profit element. And you may think, so this time value of money, this risk return, or this return which is attached with the risk, is this not a profit element? That is also a kind of profit element, because we see that to be a profit. That is actually a return. But I'm saying in terms of the real profit, A Limited or this lender would want some profit component to be there. Where will that profit component get included? Again, that will be included in this portion of 100 rupees. Yeah. If we have only these components, which I've just discussed with you, which we see in a basic lending arrangement. So what is a basic lending arrangement? Which will have these components. Something which we see in case of loan taken in the normal course of business. Then such type of return, which is termed as interest, will meet the criteria of SPPI. So then I'm repeating my point. Then such type of return, which is termed as interest, okay, which is termed as interest, will meet the criteria of SPPI. Why? Because SPPI will now have principal and interest or interest. And this interest portion is something which is as per the basic lending arrangement. But let's suppose A Limited, by giving this loan, is also getting something more. How? Let's suppose A Limited understands, as per the terms of the contract, that this B Limited is a new company, it's a startup company. I'm just changing the facts now, huh? So that's why I need your attention. Again, this is very, very important. A Limited understands today that B Limited is a startup company. And A Limited has given a loan to B Limited for a period of 5 years only. Okay, so that fact remains same. But A Limited knows that business of B Limited may pick up at any point of time, say after 2 years. Depending on the business of the B Limited, its business may pick up. Its wealth may get significantly higher. Its market capitalization may increase significantly. And that's why what A Limited wants is higher return attached to this loan of 1,000, depending on if the things go as per the expectations of A Limited. And that's why what has A Limited done? A Limited has attached one condition in this loan. A Limited says that at any point of time after 2 years, but before the end of 5th year, A Limited may convert this loan into equity. A Limited may convert this loan into equity. Now, because of this, what will happen? Because of this, after 2 years, if A Limited wants, it can convert this into equity. It may or may not, but the option is there with A Limited to convert it into equity. And if A Limited will convert it into equity, then will the return of A Limited be limited to this interest only? Or the interest like we discussed? So interest can be interest, or any type of return may still be called as interest. But will that return which will accrue or which will be received by A Limited, can we say that will be limited to this type of interest, or will it go higher than this, or which can be significantly different from this? Whether it is higher or lower, it doesn't matter. Which can be significantly different from this? Tell me quickly. What do you think in such a case? What will happen? In such a case, what do you think? I'm waiting for a response. Do you think in such a case, this return will be limited to such type of interest like we discussed, or will it be significantly different from such type of interest? Yes, quickly, I'm waiting for a response. I think Challa has got certain queries. I'll come to this. Challa, I'm waiting for a response. What do you think? What will it become? Will it be limited to interest, or do you think it will go beyond interest? Okay, Pujita is saying, sir, it will be interest plus something significant. Great. Kaustav is saying it will be significantly different. Yes. The moment we bring in any such different portion which will not meet the criteria of interest, then in such a case, can we say that the SPPI criteria will be met? No. The moment such type of condition will get attached to the contract. So what was our contract? Our contract was a debt. Debt means loan. Our contract was a loan contract, debt contract. But because this contract included an option to get equity shares, that's why there is a dilution of this debt. And because of this dilution of debt, the basic lending arrangement is not met, or you can say the criteria of basic lending arrangement is not there. It's changed now. And the moment it's changed, the moment it doesn't remain limited to interest, we will not be able to say that SPPI will be met. SPPI will automatically fail in such a case. Okay, clear on this? Yeah. So let me just go back to this presentation now. So there are certain components of interest element which we have just discussed, and now we can look at some examples, and I'm just hoping that you will be able to understand these examples. Contractual terms that introduce, you can look at the screen up, please. Contractual terms that introduce exposure to risks or volatility in the contractual cash flows, that is unrelated to basic lending arrangement. That means that is different from basic lending arrangement, such as exposure to changes in equity prices. For example, there is an interest rate in the contract. So we have given a loan, for example, and what's the term? Term says interest rate will be based on LIBOR, or interest rate will be 0.5% higher than LIBOR. So in such a case, what do we say? It's the basic lending arrangement. It's the basic lending arrangement. But if we say interest rate is linked with the equity index, is that equity index anything to do with the basic lending arrangement? No. If we say interest is linked with the gold index, that gold index has nothing to do with the basic lending arrangement. So that's why, what have we done? That's why we have diluted this. We have diluted this lending arrangement, and this dilution will not allow us to say that yes, or will not allow this SPPA criteria to be met. Okay, yeah. Let's look at some more examples. Let's say if the leverage increases. What is leverage? Again, debt. Debt is something which is termed as leverage. If it increases the variability of contractual cash flows with the result that they do not have economic characteristics of interest. Again, let's look at this example. Say interest is leveraged. So what is the contract term? Contract term says that interest will be charged 3 times. 3 times the interest which will be charged in case of risk-free interest. So where do we have the risk-free interest? Let's suppose on government bonds, interest is risk-free. Now A Limited has given a loan to B Limited, and A Limited says that I'll charge the interest 3 times the rate of interest in case of government bonds. 3 times the rate of interest in case of government bond. In such a case, what will happen? In such a case, even though we are charging interest, but are we really limited to interest which will be charged in case of basic lending arrangement? No. It's significantly leveraged. It's significantly leveraged. That's why, again, it will not be considered to be meeting the criteria of SPPI. SPPI will not be met. Again, another example. Indian loan interest rate is 5 times EPS of the company. Now we are linking this with the EPS of the company. So what does it become? Again, this is not limited to basic lending arrangement. Yeah, clear on this? So when do we say the basic lending arrangement is there, and what are the situations in which we will say that the basic lending arrangement is not there? Okay, yeah, clear? If you have any questions around it, please let me know. Now this time value of money, what is this time value of money? Element of interest that provides consideration for only passage of time. Of course, for this passage of time, yeah, for this passage of time, this provides a sort of return to the holder or to the lender. In order to assess whether the element provides consideration for only passage of time, an entity will apply judgment. Consider relevant factors such as currency in which financial asset is denominated, period for which interest rate is set. Now, how will the entity determine all of these aspects? And we are not only talking about this time value of money, we are talking about this complete interest, which is a component of SPPI. Entity will have to apply judgment. Entity will have to consider various factors. And what are those various factors which will have to be considered? These are the various factors which the entity will have to consider. Yeah, these are the various factors. That the elements of interest should be limited to this. And one thing which you need to understand conceptually, because if you get into details of all of these elements, this may confuse you. Though we have discussed about it, but still you may have a lot of confusion. So that's why one thing which you need to remember at every point of time, that's the concept. And what's the concept? That the loan or the terms of the contract should be similar to, should be consistent with what you see in case of basic lending arrangement. Okay, yeah, clear on this part? Clear on this part? Yeah. Okay. Now, before we move further, let me just understand any of your queries, please. And in the meantime, I can just get on to this query of Challa. Challa is saying, sir, I have little confusion in who is the holder and who is the issuer. Could you please explain again? Yes, sure. Second is saying, bank balance as per the bank statement is a financial asset by virtue of cash or contractual right to receive cash or any other financial instrument. Please explain. Yes, sure. So I think, first of all, I'll just quickly clarify this point because we are just slightly digressing from this concept which we've been discussing, but it's important for you to understand this. Very simply, Challa, if you would have understood this example, in this example, A Limited gave a loan to B Limited. Yes. Similarly, I can add some more points over here. A Limited issued preference shares, and these were issued to C Limited. Your first confusion is who is the holder and who is the issuer. See, when A Limited has issued the preference shares, can we say that A Limited holds preference shares? Is it possible? No. Who is holding the preference shares? C Limited. Who will become the holder therefore? C Limited. And who will become the issuer in this case? A Limited. Correct? So C Limited is the holder and A Limited is the issuer. Okay? This was easy for you to understand. Now, when A Limited has given a loan to B Limited, now A Limited has given a loan. In this case, who is holding the asset? Is it B Limited or A Limited? Who is holding the asset? A Limited. So that's why in this arrangement, A Limited will not be an issuer. A Limited will be a holder. So now A Limited becomes holder. And B Limited in this case will become issuer. You may be thinking, but sir, B Limited has not issued anything. See, by issuance, you need to understand the meaning of the issuer, which doesn't mean that it's required for the issuer to issue some instruments, which will be in the nature of equity shares or preference shares. It could be any instrument. In this case, B Limited has also issued an instrument, which allows A Limited the right to receive cash from B Limited after a fixed period of time. That's why in this case, who is the holder? A Limited. Who is the issuer? B Limited. And another query which may come to any of your minds. Now, any of you may be confused with this. That is it possible for A Limited to become issuer as well as holder? Of course, yes. And it's not only possible. At multiple places this will come, because an entity will not be limited to only single transaction. They will carry out thousands of transactions, hundreds of transactions, lakhs of transactions. And either of these transactions could make an entity as issuer or holder. Yeah. Now clear on this point? I'm hoping with this automatically your doubt related to the bank balance as per the bank statement will get resolved. Because if you look at the bank balance, you need to again understand it from the perspective of customer who is having the bank balance. Let's suppose you are having a bank account. For you, your balance in bank account is what? An asset for you. Who is the other party? Bank. Now for a bank, is that balance which you have maintained in the bank account an asset? No. That's a liability for the bank. Bank is required to pay this amount to you whenever you will demand. So that's why for a bank, it's not an asset. For a bank, it's a liability. Now clear on this point? Yeah? Okay, Kaustav has a query. Kaustav is saying, says substance of the transaction over its form will be seen for deciding whether the loan is in consistency or is consistent with the basic lending arrangement. Yes, of course, we'll look at the substance. See, when we talk about substance over form, that means we need to go beyond the legal form. But that doesn't mean that you will go beyond the contract. You have to stay within the contract. You'll have to understand the contractual arrangement. Okay. And while getting into the contractual arrangement, we will not be required to only look at what the legal requirements will say. Okay, because the legal requirement may give us a different answer. While going through the terms of those contracts, we need to understand that when these parties enter into this contract, what was the understanding which they wanted to have. Okay, that detailed assessment we need to do. That is called as substance. Okay, that is called as substance. Clear on this? Yeah. Okay, Anjali has a query. Anjali is saying, sir, in the example when A Limited is giving a loan to B Limited, so A Limited is the issuer and B Limited is the holder. No, I think I clarified this point, Anjali, and I'm hoping you're clear on this now. In this case, A Limited is not the issuer. Who is the holder? Who is having the asset? A Limited. Clear? Yeah. Okay, so now moving further, in case you have any more queries, you can just keep sending up. And it's good that you share your queries. And please do not hesitate to ask any questions. Some of the questions you may believe are very, very simple to be asked, but that's okay. And that's very, very important. Okay, so now this was about the time value of money, or we can say about the SPPI or the interest component, mainly in case of SPPI, which was first part of our assessment in relation to contractual cash flows. Let's look at some examples now, because there is one test which is required to be passed, like we just discussed. What was the test? That the contractual cash flows should be collected by the entity. So let's see, this test will be passed by which all entities? Instruments. So let's look at the left hand side. I'm limited to the screen which is there in front of you. Some of the instruments that will qualify this cash flow characteristic test. A bond with a stated maturity date. So there's a bond. Bond means a bond has been issued by a company and maturity date is stated. So let's suppose maturity period is 10 years. Okay. In this contract of the bond, principal and interest are linked to inflation index. They are not linked to equity. They are not linked to, say, gold index like we just discussed. They are linked to inflation index. That is not leveraged. That is not leveraged means that is in the normal course. Now, when it is linked with the inflation index, so can we say that this will be something which will be in the context of basic lending arrangement, which will be consistent with the basic lending arrangement? The answer is yes. Because if you look at the inflation index, that is not breaching the requirements of basic lending arrangement. That is not going beyond the basic lending arrangement. That is within the purview, within the or consistent with the basic lending arrangement. Okay, yeah. Let's look at one more example. A variable interest rate loan with a stated maturity date. Now the loan has an interest rate which is variable. Stated maturity date means maturity period is there. Let's suppose it's 7 years now. It permits the borrower to change the period of market interest rate at each interest reset date on an ongoing basis. So now the borrower is permitted that he can change the period of market interest rate, but which is normal in any borrowing arrangement, it's possible. Till the time this loan has an interest rate which is there as per the market norms, can we say this will meet the test? Yes, it will meet the test. Yeah, so it will also meet the test. Another example. There is now a bond with a stated maturity date and this pays variable market interest rate. So variable is fine. Interest rate is also as per the market norms. But this interest rate is capped, means it cannot go beyond a certain limit. This interest rate is capped. It cannot go beyond a certain limit. So is it okay? Yeah, this is okay. Because if this is capped, it cannot go beyond a certain limit. So we are not saying this is significantly leveraged. We are just capping it. So if you are capping it, it's absolutely okay. Yeah. Next example. A full recourse loan secured by collateral. Now again, there is a loan. But now in case of this loan, there is a collateral. There is a security. Collateral, you can say it's a kind of security which is given. Okay. Now, if there's a loan against which a security has been given, do we see in the normal course of a basic lending? Yes. Do we see in the normal course borrowings are having any collaterals attached to it? Yes, there are a lot of secured borrowings. That's why again this will meet the contractual cash flow characteristics test. Yeah, simple and easy to understand. Okay. Now we'll look at some examples of instruments which should not meet this test. And the first one I think is very, very easy for you to make out. A convertible bond that is non-convertible into equity instruments of the issuer. Yes, all of you. A convertible bond that is convertible into equity instruments of the issuer. Will you say that this instrument or will the convertible bond meet the contractual cash flow characteristics test? I think answer is there in front of you. It may or may not be correct. As I've told you, please don't go by the answer which is there on the slide always. But what is important for me to understand is the reason. Now for this part, okay, so for this example, can you tell me what is your assessment? Anjali and Chala, I'll come to your queries. Huh? Please wait. Can you now tell me quickly, for this example, will you say the test is passed or not? Will it qualify or not? But the most important part for me to understand is the reason. Why will you answer this as yes or no? Quickly. Yes, quickly. Okay, Chella has a point in the meantime. He's saying based on the inflation index only, interest rates have been fixed or determined by the banks or other financial institutions. It may all change index of price. There are chances that index of prices have been affected, so that SPPI condition always will get affected. Yeah, so as it's not that SPPI condition will be affected, SPPI condition will be met, because if this is limited to inflation index, so that's why something which is happening in the market is in the normal course of any borrowing arrangement. So something which is attached to borrowing arrangement, which happens in the normal course of business, that is what you need to consider. So that's why when you say SPPI will be affected, so SPPI will be affected, that's fine. But to say that SPPI will fail will not be correct. Yeah, so when I say SPPI will be affected, so it's dependent on the market interest rate. So if that's the context which you want to understand. Okay. Ashita is saying for this example. Yeah, so let me just put a number. So I'm saying example number A. So I'm just giving this A because we can identify this. A lot of queries are coming. So Ashita, I think, has answered for example number A. Ashita is saying, sir, no, this will not pass the test as we will not collect the principal. Okay, this is a fair point. Principal will not be collected. But when you say principal will not be collected, is that the only perspective that we look at? And when you say principal will not be collected, why do you think principal will not be collected? So is it like that this money will not be recovered, or what's the reason? Anjali is saying, sir, it will fail SPPI, so it does not qualify. And why do you think it will fail SPPI? Because that's what I want to understand from all of you. Yes, so there is the response from Rohita. Rohita is saying, as this is not as per the basic lending arrangement. Pujita is saying conversion can happen at any point of time from the date of issue. So there's no contractual cash flows subsequent to such change. And Kostav is saying, sir, it's not consistent with basic lending arrangement, it's significantly different. Yes, so there you are. Please understand that when you look at this type of arrangement, wherein we have a loan, loan in the form of a bond, but that bond is convertible. So now what's the arrangement? That this 1,000 rupees after 5 years will not be paid back to A. Will not be paid back to A. Instead, what will happen? Instead, what will happen? Instead, what will happen? After 5 years, A will not get the money back. Instead, B will issue equity shares. So B was required to pay money after 5 years, but now B is not paying the money. B is issuing equity shares. And that's why money of A is now in the form of investment in equity. Correct? And when the money will be invested in equity, so will the return from equity meet the criteria of interest or return which is limited to interest as per basic lending arrangement? No. So that basic lending arrangement criteria will fail. Though the point is also fair that this principal may also not get recovered, which is true, because if you invest in equity, then you are not sure whether your principal will also come back to you or not. So effectively, what are we saying? SPPI in such a case will fail. That's why whenever you will have any investment in equity instrument, in such a case, SPPI will always fail. Any investment in equity instrument will always not meet the criteria of SPPI. That's why it will never go to amortized cost bucket. Clear? Yeah. Okay, so now I'll just get back to the queries of Challa and I think who had this query? Anjali. Okay. So Anjali is saying, sir, how can the B Limited be the issuer of the loan in this case? A Limited has given the loan and is the holder of loan, I understand. But B is issuer how? See, there are two parties. That's how you need to understand it. One will be a holder and other party will always be considered to be an issuer. So when you say that A Limited is the holder, okay, that means the other party will become the issuer. And let's understand why. You are saying that you agree that A Limited is the holder. Okay, you agree that A Limited is the holder. So if you agree that A Limited is the holder, so that means for A, it will become an asset. This bond is what? An asset. It is giving A the right to receive cash from B Limited after 5 years. Correct? Now let's look at it from the perspective of B Limited. For B Limited, what will this instrument become? B Limited has a contract and that contract requires B Limited to pay cash after 5 years. If this is not converted, so I'm just not getting into that condition of conversion. So that means B Limited will be required to pay cash. So for B Limited, what will it become? Financial liability. Yeah. And you look at it financial liability from the perspective of issuer. Let's suppose there is a conversion clause which requires that after 5 years it will be converted into equity. There again, what will happen? For A, it will be an asset. Today, it's an investment in debt after 5 years, which will convert into equity legally. Let's look at it from the perspective of B. After 5 years, B will issue equity shares. So for B, today, it's a liability. After 5 years, it will become equity. Again, I'm going by the legal terms. I'm not going by accounting terms as of now. Clear? So there again, what do you see for B? It's either a financial liability or an equity. So that's why we are calling it to be an issuer. Clear now? I think Challa has a lot of queries. So let me just go to the queries of Challa now quickly. Challa is saying, my question regarding the bank balance IDs is not resolved. Financial asset by way of cash or other financial asset. See, when you look at the financial asset definition, bank balance is covered in the definition of financial assets. That's why by the very definition it's covered. but you need to understand that financial asset is always looked at from the perspective of holder. Yeah, I'm hoping this answers your query. Then the other query of Chala is, okay, then the other thing was answered. Now he's saying, so your previous explanation related to price index query, from my side, I understand. Could you please explain? So he wants me to elaborate. I think that is on the point related to the index linking. So we discussed one example wherein interest rate was linked to inflation index. Okay. When you look at the inflation index is again as per the market norms. You can just say this is something which will happen in the normal course in the market. So something which happens in the normal course in the market, if you link something to that and which is attached to the basic lending arrangement. So you may say that, sir, equity index is also there in the normal course in the market. That's fine. But equity index has nothing to do with the interest rate. But inflation has something to do with the interest rate, because inflation is one of the factors that you'll consider in your interest rates also. That's why that was considered to be okay in terms of checking whether it's consistent with the interest portion or not. Yeah, I'm hoping with this you are clear on. Okay, Anjali is clear now, and I'm hoping Chala is also clear on this now. Yeah. So let me just go back to the examples that we were discussing. See, these are very, very important examples. All of these examples you can also practice later on. If you want to mark it, you can also mark it. But many of your examples in the study material, many of your illustrations in the study material are based on these examples. So what we have really tried to do over here is this presentation that you see on the screen is more of a compressed version. Yeah, so each and every aspect that I've been discussing with you happens to be from the study material only. Yeah, whether it's about any of the topic or most of the examples also. But what I've tried to do in the form of this presentation is to compress that. So you can say it's more of a summary of your chapter in the form of this presentation, which can help you later on for the purposes of revision. But at the same time, please also note that when I talk about summary, it's very, very important for you also to make the summaries for the purposes of revision. And it's not necessary that you should use only this summary. And the next question which you may have is about sharing of this presentation. So this presentation will also reach you very shortly. I'm not sure whether it has reached you or not. Very shortly it will reach you. But even if you have this presentation, you should make sure that if you want something to be added to this as part of your notes, so in a way that you want to bring in certain examples over here by just marking that this example is linked to this point or this example is linked to this point, or maybe you want to add some more notes to whatever is written over here, you should do that. Yeah, because that's how you will be able to revise the concept later on as per your understanding. Okay. Yeah. Now moving further on to the next example, a loan that pays inverse floating rate. That is, interest rate has inverse relationship to the market interest rate. So can we say that will meet the SPPI criteria, that will meet the contractual cash flow characteristic text? No. So that's why it will fail that criteria. Next, a constant maturity bond with a 5-year term. So there's a maturity bond again, you can say a type of loan, and the term of the loan is 5 years, that pays variable rate that is reset periodically, but always reflects a 5-year maturity. So something like this. See, there's a 5-year term bond on which interest rate is reset. So today, let's suppose interest rate is set. After the end of first year, interest rate will be reset. After the end of second year, interest rate will be reset. So if you look at the borrowing arrangement, resetting of interest rate is normal. But in this case, what's the problem? Every time the interest rate is reset, see, when you reset after the end of first year, after second year, so let's say somewhere over here, every time it is considering 5-year maturity. Is that correct? No. Because if you reset after 1 year, what's the maturity period? Now the maturity period is 4 years. So accordingly, it should consider the factors. It should consider those factors which will be related to 4 years maturity instead of 5 years maturity. So that's why there's something again going different from what you see in basic lending arrangement. Clear? Clear on this? Ashita is saying, sir, can you give a real life example of inverse floating rate is used? No. No. That's why I'm telling you. So this is only an example to explain you that in case there will be an inverse floating rate, then in the normal borrowing arrangement, you will not see this. And that's why it will not meet this characteristic test. And that's why whenever any such term will be attached in any of the contract, that contract will not be considered to be that of a borrowing arrangement. So its legal form may still continue to be a borrowing arrangement. Though again, legally it may be challenged. I'm not getting into the legality right now. I'm more towards the accounting requirements in relation to this. So that's why whenever it will come to the accounting requirement, we'll have to just check whether it will meet the basic lending arrangement, and because it will not be done, that's why we will say it should not be the criteria. Challa is saying, from your explanation related to price index or the prices, convertible bonds also from the basic lending arrangement itself conveys that giving shares at maturity date, then why should we not consider amortized cost for this transaction because of fixed amount of giving shares at the fixed maturity amount? So Challa has a point. Challa is saying that, sir, in such a case, if we look at this arrangement that we have just discussed so far, why should the convertible bonds not be considered to be treated at amortized cost? I think somewhere there's a big understanding gap, Challa, and that's why it's very, very important for you to please listen carefully. See, when you talk about convertible bond, please understand. I think I need to clear this. Please understand, because it appears there's a big understanding gap. First of all, you need to understand how will a convertible bond work. Convertible bond will work in a way that after the end of 5 years, if A has given a loan to B, then B will not be required to pay back the loan. So the repayment of principal is not happening, number one. Secondly, if we talk about the interest, you may be right in saying that at the end of first year, interest will be paid. Second year, interest will be paid. Third year, interest will be paid. Fourth year, interest will be paid. Fifth year, again, interest will be paid. This is absolutely true. In all the 5 years, interest will be paid. But is this contract coming to an end at the end of the 5th year? No. The contract is continuing. Why? Because even the contract is colored saying that it's convertible bond, after 5 years it will convert into equity, but the contract has not come to an end. Contract continues till the time the instrument is completely mature. Instrument is not matured, it's converted from bond to equity. On this date, the instrument has been converted into equity. So it continues. It's not coming to an end. When will it come to an end? Now, because this has become equity. So this will go on forever till the time the company remains. And can we say that an instrument which has an equity component can ever pass the SPPI test? No, because what do we look at? We look at the overall term of the instrument. Though again, in this case, there's one point which no doubt can be ignored. That is some portion of liability in this instrument. Some portion of liability exists in this instrument. There's no doubt about it. And that's why such type of instruments will become compound finance instruments. Okay. But compound financial instruments we have not yet discussed. We'll discuss that in detail later on, not now. Number 2, compound financial instruments will only be considered from the perspective of issuer. Who is the issuer here? B. A is not the issuer. For A, there's no concept of compound financial instrument. For A, there's only one asset, financial asset. And this financial asset has to be bucketed into 3 categories. Amortized cost, fair value through OCI, fair value through P&L. Will it meet the criteria of amortized cost over its term? No. Why? Because SPPI will fail. That's why it cannot go to amortized cost. That is how you need to understand this, Challa, please. And I would strongly advise you to please revise the portion of the last session in relation to financial asset. That will help you to clarify some of these points, and please practice some of the questions once again. I'm hoping all of these things will clear. Ashita is saying, sir, in case of convertible bond, if the holder, that means A, has the option to encash instead of converting into equity, then which model will be used? Then I think you're saying whether it will be amortized cost, whether it will be fair value through OCI or fair value through P&L. Yeah, that's the point. And again, I'm just hoping that you are limited to holder. You are not looking at the issuer side. Yeah, is that correct? Okay. So let's just understand that if the facts are changed the way Ashita has just mentioned, then what will this instrument become? Now, what's the term of the contract? That after 5 years, loan will be converted into equity. Okay. And holder, that means B, has the option up to 5 years, means before maturity or before conversion. In fact, before maturity, instead of saying before maturity, we should say that before conversion, A can convert this, A can redeem this at any point of time. Now, in this case, what do we need to check? We need to check what's the intent of A. Because who has this option of redemption? Only A. B doesn't have the option of redemption. That's why in this case, we'll have to analyze whether A wants to redeem this or not. In case A wants to redeem this always, and A is very clear that A will not wait for the conversion, and before that A will redeem it for sure, then in such a case, what will A get? A will get principal and A will get interest, which is as per the basic lending arrangement. Okay, yeah. So that's why in this case, this will be considered to be at amortized cost because it's convertible at the option of A, wherein A's intent is very clear at the beginning itself, because we need to check at the beginning that A will not convert this into equity. A will get this redeemed. Accordingly, A will have to treat this. Clear? Yeah. Okay, so then we can move further, I think. Yes, moving further on to the business model. Now, what was the first condition? That there should be a business model, and the business model should require to hold the financial asset to collect that till maturity. So the business model is not to sell, number one. And this was in case of amortized cost. Otherwise, the business model could be involving sale of financial assets. Yeah. In case it involves sale of financial assets and it becomes a mix, then it goes to fair value through OCI. Or the business model could be only about sale of financial assets. Let's take some practical examples wherein it will work. If you look at asset management companies you all know, yeah, AMCs, they have their portfolios. Within their portfolio, they have assets. For example, they will give some advances, they will give some loans to certain parties. Okay. Some of those loans will be held till maturity. Why? Because they want to earn interest on that. And some of the loans will not be held till maturity. Those will be sold off. And as I told you, it's sold in the market. You can just sell your loan. You can just sell your receivable in the market. There are entities which buy this. Yeah, financial institutions are involved in the sale of financial assets. For asset management companies, this mix model is very, very common. So that's why for such type of companies, practically you see that their portfolio will have financial assets which will be at fair value through OCI. Okay. But for non-financial institutions, say for example, for a manufacturing company, for a trading company, for a construction company, for such type of companies, you will not see such type of business model. Mix will be happening. Mix in the sense holding the asset as well as selling it. It's not done. Sale of financial assets significantly or on a mixed basis will be seen in case of financial institutions. Okay. Now, around this business model, what do you need to understand? First, this has to be based on facts. Management cannot say, okay, I want to assume this. I have this intent of doing this. So whatever is being done, whatever has been done in the past, that should become the basis for our assessment, for our understanding of the business model. We should not be thinking that, oh, in the future, that's the plan of the management. Oh, they want to do this, that's their intent. Unless that's substantiated, we will not consider that to be a part of the business model. Yeah. Who will determine this? It's of course the key managerial personnel. It's the key managerial personnel who will determine this. Okay. Yeah. Now, for this business model, there are certain aspects which we need to consider. In this business model, let's quickly understand the objective. Objective is to collect contractual cash flows till the life of the instrument. Means either you collect it over the life of the instrument or after the life of the instrument. Yeah. In this case, some of the factors which are considered are about the frequency of sales in the prior periods, value of sales in the prior periods, timing of sales in the prior periods, and the reasons for sales. Let's see what does it mean. Say an entity's business model is to hold to collect. That's the business model. But during the year, we have seen that 3-4 financial assets were also sold. They have not been selling financial assets majorly, but we could see some of the financial assets were sold. So if only some of the financial assets have been sold, which are only few, can we say that that will impact the business model and because of which we will not classify an asset to be amortized cost? No. In case there are few sales, that will not impact the assessment that will not impact the categorization of amortized cost. That's okay. Until unless there is a pattern available. Let's see what the pattern. Let's suppose an entity's business model is hold to collect. And throughout the year, they have been doing this except in the month of February. Because every time in the month of February, they are selling their financial assets. Otherwise, they are not selling it. So in such a case, what is happening? There's a fixed pattern. Maybe their business model is such which requires them to sell their financial assets during a particular period. So in that case, we need to just understand some of those points as to why they have been selling their financial assets. Is it because of certain exceptions, or is there that their business model is such that during a particular period, only those financial assets will be sold, otherwise it will not be sold? Because if that's the case, if that's a pattern, if that can be established, then we'll say it's a mix of both, and that will not be considered as an exception. Yeah. When we talk about some of the sales, wherein we are saying we can just ignore some of the sales. So we'll not only go by the count of the sales. So like, for example, I said that during the year, there have been thousands of transactions in which only 10 to 15 transactions were sale of financial assets. In such a case, other than this number of transactions, we also need to understand the amount. Maybe these 10 to 15 transactions out of thousands of transactions were of very significant amount. So we also need to consider the value over and above number of transactions to analyze which should be considered as hold to collect and which should not be considered as hold to collect only. Yeah. And of course, while looking at this business model, the entity's expectations about the future are also required to be considered. But now this point needs to be understood very, very carefully. When we say that the expectations are required to be considered, I'm not saying that we will go by the intent of the entity, which I just told you. Yeah. So in this case, what did we say? That this will not depend on management's intentions. It has to be as per the facts. Okay. So when I say expectations about future, you may get confused. You may say, sir, then what is this expectation about future? Expectation means, is that the business model of the entity now changed? And in the future, this is how it's going to work, which is more than the intent, wherein some actions have been taken by the management to substantiate that the business model will work in a different manner or in a certain manner in a future period, which is not limited to the intent of the management. Okay, clear on this point? Yeah. We can look at some examples of exceptions now. Say policy to sell assets when there is an increase in credit risk attached with the asset. So when are the financial assets getting sold? When the risk which is attached with them is significantly increased. So just to do away with that risk, only management is selling. Otherwise, they don't plan to sell it. Otherwise, they will hold. Only in exceptional cases, they are selling. So if they are selling it only in those exceptional cases, can we say that the model will not remain hold to collect? It will also include sale? No. Those sales will be ignored. Another example. Sales which are close to maturity of assets, where proceeds approximate remaining contractual cash flows. Now what has happened? So we are quite close to the maturity period. Quite close means only a month is left. And let's suppose out of 5 years period, entity has waited for 4 years, 11 months. Now, during the last month of the term of the contract, it's been sold. So that can also be considered to be an exception, because effectively they have covered the period. majority of the period. In fact, it's not only majority, almost the maturity period has been covered. So that's why that can also be a part of an exception, wherein even if it gets hold, that can be ignored. That cannot be considered to be said that it's not limited to hold to collect. Okay, yeah. Now let's look at this example. Entity A has a portfolio of financial assets, which is a part of held to collect business model. Due to change in the legal requirement, entity A has sold some of the assets and has to significantly rebalance its portfolio. In such a case, because of the sale of some of the assets by the entity, can we say that the business model needs to be assessed or changed? No. Why? Because this selling activity, which one? Wherein the entity has sold some of the assets. We are not saying it's only some. That's why it's considered to be an exception. No. It's an isolated or one-time event. It's an isolated or one-time event. It's not the business model of the entity. Business model is always to collect. And to collect on the date of maturity. That means entity is always holding to collect. But because of this rebalancing of portfolio, which was required to be done by the entity, which was a sort of mandate on the entity. Why? Because legal scenario was such. That's why these have been sold. Okay. However, if the rules require entity to routinely sell these financial assets on a go-forward basis from its portfolio and the value of assets which will be sold will be significant, then we will say that the business model is no longer hold to collect. This will now start including sale of financial assets. Clear? Clear on this point? Yeah. So there are two things we have discussed. One, that certain sales or certain exceptions wherein the sales of financial assets will occur will not change the business model from hold to collect to including sales. But if the sales are going to come repeatedly in the future, we need to check why are those sales coming. So it's all about understanding in greater detail the business model of the entity. Clear on this? Yeah? Clear on this? Yeah? So now I have this another query from Challa. Challa is saying, in case of convertible bonds into preference share. Okay, yeah. So I think his query is running again around the same point. So what we can now do is we can take a break of 10 minutes. Yeah, after the break, we'll continue with our discussion on this same point of the business model. And we'll also get on to some illustrations of the study material which are based on the same topic. Yeah. All right. In the meantime, if you have any query, if you believe any of your queries missed out, please resend them. And I'll just get on to the query of Challa. So we can just meet after 10 minutes. And I'm looking at the query of Challa. So Challa, you can just stay around, please. So he's saying in case of convertible bonds into preference shares with fixed interest rate, has your explanation changed to my previous query? No. See, my explanation will not change throughout the course of this session and even after that, because till the time standard will not change, my explanation will not change, because my explanation will always remain same. Yes, it's for sure that there are a lot of things which are yet to be discussed. So depending on a lot of new concepts which will come, your confusion may keep increasing, but don't worry about it. It's always natural and normal to have that, particularly in this topic. So that's why I would suggest you one thing, that please break all of these discussions into certain parts. First, we discussed about the definitions. If you are clear on that, just revise that part. Once you are done with that, forget the definitions for the time being and then get on to the classification, because I can see there's a lot of confusion wherein you're just trying to mix up a lot of topics which may be bothering. Next is the classification. Just try to read this classification part and forget the definition for some time. Just understand the classification. Within those classifications, we are now getting into the details as to how that classification happened. For example, we are getting into the business model, we are getting into the SPPI, we are getting into the time value of money, we are getting into the contractual cash flows. So all of these aspects are related to classification of financial assets, wherein we are picking up different types of examples. Okay, so that is how I would suggest you to break your revision, which you can do maybe after the end of today's session. And after that, if you still have any query, then please feel free to reach out to me. Huh? Okay, yeah. So with this, we can just now move on to the break, please. Huh? And after the break, we'll meet. 10 minutes, huh, please. Okay. Hi, welcome back. So we can now continue the discussion. So I have this query from Kaustav first of all. So Kaustav is asking, sir, in the example which we discussed at the last, what if as per the rules, the entity is required to sell periodically, but the value of the sale is not significant? Will it still be held to collect business model or will it change? See, therein again, we need to understand that when you say that the entity will be required to sell frequently, periodically, but the value of sale is not significant. So therein, because the entity will be selling periodically, frequently, we need to understand, is it because of the business model of the entity, or is it because of certain reasons they are required? Because if the business model per se has changed, then will not be limited to the amount, will go by the understanding of the business model. So in all of these cases, even though we have been discussing a lot of examples, a lot of situations, you need to understand conceptually that it's the business model of the entity which is getting analyzed, and accordingly you need to conclude that. Fine. So now we can just move further. Now, in relation to held to collect and sell business model, which will include both these components, let's look at one example. A bank holds financial assets to meet its everyday liquidity needs. That's the model. The bank seeks to minimize the costs of managing its liquidity needs and therefore actively manages the return on this portfolio. The bank typically holds some financial assets to collect contractual cash flows and sells others to reinvest in higher yielding assets or to better match the duration of liabilities. And why is this done? That's the strategy of the bank. That's the model of the bank. That's how the bank has been managing its portfolio, and that's how the bank has been managing the returns on its portfolio. This strategy has resulted in significant and recurring sales activity in the past, which is expected to continue. And what is this sales activity which they are saying? This sales activity is because of this reinvestment. Now, in this case, can we say that these sales are being made only for reinvestment, only for getting higher yields? That's why it should be ignored? No, that's the model. That's the model of the bank. That's the model of the bank through which it is managing its portfolio. So in its portfolio, that's how it's trying to increase its return, maximize its returns. That's why in this case, can we ignore these sales and say that this is only hold to collect? The answer is no. In this case, it will be considered to be hold to collect as well as sell. Clear on this? Yeah. Another example. Entity Z operates in the entertainment industry. Its operations include a sports stadium. Z has long-term plan for renovation of this stadium involving significant investment at set points 3, 7 and 10 years. Means significant investment will come after these intervals or at these periods of time. Anticipating this expenditure, Z invests surplus cash in bond assets. Many of the bonds have maturity dates that substantially exceed the points at which stadium expenditure is expected to take place. So let me just explain you this point to you. So after 10 years or maybe during this year, significant expenditure is expected. After 7th year or maybe during this year, significant expenditure is expected for certain purposes. After 3 years, significant expenditure is expected. Yeah. Accordingly, this entity has made investments in financial assets, or you can say, accordingly, entity has been managing its financial assets. But say, for example, if we talk about some of its financial assets, they do not have their maturity period which is matching with these dates. Instead, their maturity periods are crossing these dates significantly. They are not completely aligned. So it's not that that entity has one investment which will mature on this date so that they will get the funds which can be utilized for expenditure. Instead, their funds are going beyond this date. Similarly, another financial asset which is say going beyond this date. Yeah. So the question says they are not completely aligned with the expenditure plan. Yeah. In this case, before we get to the answer, can you all tell me about this entity? What will you say? What is your view on the business model of this entity? Quickly. Yeah. All of you, quickly. Yes, quickly. What do you think about the business model? I'm not going back to the presentation because I think the facts are all explained and majority of the facts I have put on the board also. So can you tell me your views about the business model of this entity? Quickly, huh? What do you think about the business model of this entity? What will be the business model of this entity? What will you call it as? Hold to collect and sell. What do you think? Yes, I'm waiting for a response. And you should give reasons also, huh? Please, whenever you give the model. So I'm waiting for your answer. Yes, quickly, huh? What will be the business model in this case for this entity? Yes, quickly, huh? You need to respond quickly. I think all thoughts, etc., would have been applied by you. What do you think? What do you call this model as? Okay, Bhargav is saying, so we can expect the entity to sell the financial assets for the requirement of cash, which is fine. But what about the business model? What is your response on the business model of this entity? Challai is saying they have to sell. Anjali is saying I have not understood the example. Okay, no problem. So I'll go back to the example also. In the meantime, Neha has responded. So Neha is saying it's a business model held to collect and sell. So Neha is saying it includes both. Challa is saying it's only to sell. Hold to sell. That means only to sell. That's what I can understand from your response. What about others? Any more responses from your side? Bhargav is saying we can say that the model might fail to call as hold to collect only. That means he's also saying it should include sale. What about others? Any more responses? Pujita is saying hold to collect model because its goal is to collect cash for future expenses, and the same can be done by selling to meet the cash requirements. Okay. Costa is saying hold to collect and sell because it may sell some asset when it requires money, whereas it can hold on to the others. All right. What about others? Any more responses? So I'll just go back to the presentation now because some of you are not very clear on the question. Okay, now in this case, if you look at the facts, entity is holding these bonds to collect contractual cash flows until it needs cash. Until it needs cash at these intervals. So what's the objective of the entity? What's the objective of the entity? Objective of the entity is to hold. It may also make opportunistic sales if the management considers that market prices rise to the levels that significantly exceed their own assessment of the bond's fundamental valuation. Accordingly, the bonds held by Z would be accounted for under hold to collect and sell business model. Yeah. In this case, to say that the entity will only be holding, will that be true? No. Because it's clear that after certain intervals, funds will be required. That's very clear. Funds will be required, and for which sales will have to be made. And these are not exceptional sales. These are very much part of the operations of the entity, so very much part of the business model of the entity. Okay, clear on this? Yeah? Yes. So moving on to the next category, which was about other business models. What were the other business models? That was residual category. That was residual category, wherein entity was not holding the financial assets to collect. Instead, entity was only involved in selling the financial assets, or wherein the contractual cash flows in the business models were not limited to SPPI. Speaking about the fair value through OCI category in this case, right? So what were the examples? Assets managed with the objective of realizing cash flows through sale only. Portfolio that is managed and whose performance is reevaluated on a fair value basis only. Portfolio that meets the definition of held for trading. Held for trading means it's held for trading only, it's not held to collect. So these are all examples of the remaining categories or the residual categories which will fall into fair value through P&L. All right, yeah. So now before we move further, we can discuss some more examples on the business model as well as on this contractual cash flow characteristic test from the study material also. And now Anjali is clear on this. Very good. So I would suggest you please go to, I think we can pick up illustration number 2. Illustration number 2, this is page 12.63. Page 12.63, illustration 2. And you should also mark your homework illustration 1. I think it's page 12.62. Yeah. Okay, so let's get on to this illustration now. An entity's business model is to purchase portfolios of financial assets such as loans. The portfolios may or may not include financial assets that are credit impaired. Credit impaired means wherein the credit risk is significantly higher. You can say which have become bad. Bad means which are not getting recovered. It's about loan. So loan is given, that is not getting recovered. So the portfolio may or may not include such type of loans. Okay. If the payment on the loans is not made on a timely basis, the entity attempts to realize the contractual cash flows through various means. For example, by contacting the debtor by mail, telephone, or other methods. So that means if the entity is not realize the money, so what will they do? They will reach out to debtor. They will call them. They will send them mails. Various communications will be done to realize the money. So that's how they have been operating. The entity's objective is to collect the contractual cash flows, and the entity does not manage any of the loans in this portfolio with an objective of realizing cash flows by selling. So that's not the objective. In some cases, the entity enters into interest rate swaps. So there's a contract which they will do to change the interest rate on particular financial assets in a portfolio from floating interest rate to fixed interest rate. So what the entity will do, you can say entity has got financial assets. Say various A, B, C, D, E, F, G. So there are various financial assets. So all are held till maturities. That's the objective. That's the objective. But for some of the financial assets, so these are all loans given by the entity. You can say it's a financial institution. Entity wants to change their interest from floating rate to fixed interest rate. So that's why entity will enter into another contract with a third party, which is called as interest rate swap. So that's a kind of contract. Okay. Now in this case, you are required to evaluate this business model. What will you call this business model as? Yes. What will you call this business model as? Yes, quickly. What will you call this business model as? Yes, quickly. I think easy for you to answer. The only thing is this another arrangement which is attached. You need to consider this and accordingly you should answer. Will this change the business model or will it not impact the business model? Yes. I'm waiting for your response. Okay, Guru Raja is saying, sir, it's hold to collect. All right, what about others? I think it's very, very easy. Preeti is saying, sir, the business model is hold to collect. Contractual cash flows are collected. There is no intention to sell. So that means you are saying that this interest rate swap will not have any impact on the business model. Is that correct? Yeah. What about others? Any more responses from your side? Quickly, any more responses from your side? It's very simple, Vana. I think the only thing which you need to evaluate is about this arrangement. Ashita is saying held to collect as only in exceptional base cases, increase in credit risk will arise and it will be sold. No, the sale will not take place. It's nowhere mentioned. Swap of interest rate is in the normal lending arrangement and therefore it will not impact the business model. Very good. Kostav is saying again it will be hold to collect. Same as the response from Pujita. Great, very good. So now we can move on to another illustration. We can move on to another illustration number 6 and you can just mark 2 we have completed, 3, 4 and 5 as your homework. Okay, so we are moving on to illustration number 6. Page number is 12.65. Yeah. You may be thinking there's so many illustrations. Yes, you need to now start practicing all of them. These are all small illustrations. Huh? A financial institution holds financial assets to meet liquidity needs in a stress case scenario. Stress is when there is problem. Example, run on the bank's deposits. The entity does not anticipate selling these assets except in such scenarios. So in case of stress case scenario, there could be sale of financial assets. Entity monitors the credit quality of the financial assets, and its objective in managing the financial assets is to collect the contractual cash flows. The entity evaluates the performance of the assets on the basis of interest which is earned on those financial assets and the credit losses which are arise. Credit losses will arise when the money is not collected. So let's suppose the loan given was for 1 lakh, but entity could only collect 95,000. 5,000 is not collected. So that's the loss which the entity will have to bear. However, the entity also monitors fair value of the financial assets from a liquidity perspective to ensure that the cash amount that would be realized if the entity needed to sell the assets in a stress case scenario would be sufficient to meet the entity's liquidity needs. Periodically, entity makes sales that are insignificant in value to demonstrate liquidity. Okay. Evaluate the business model. So in this case, what do you think will be the business model of this entity? Quickly. Yes. Yes, what do you think? Because in this case, there are a couple of points which are important for your understanding. Entities having this portfolio for which fair value assessment is done by the entity. Fair value assessment, you can just say simply for the time being, say they keep checking the market valuation sector. And why is that done? To check the liquidity needs. Because in case the assets are not recoverable in stress case scenario, then the entity will sell them. Entity will sell some in stress case scenario, and when the entity will have to sell them in stress case scenario, so they need to check will they have adequate funds by selling them in the market, for which they keep checking this at regular intervals, through which they keep checking their liquidity assessment. So they keep doing their liquidity assessment. So in this case, what do you think will be the business model? Neha is saying it's the business model to collect, hold to collect, because the objective is still to collect the cash flow. Rohita is saying hold to collect. Okay, Chella is saying hold to sell. That means to sell, because company is measuring at fair value to liquidate the assets. Okay, any more responses from your side on this? Pujita is saying it's hold to collect because concern is managing the financial assets to collect contractual cash flows. But if there is a problem in recovery, in stress case scenario, only then they will sell the assets to maintain their liquidity. All right. Raja is saying main business model is to hold to collect because stress case scenario sales are. Costa is saying hold to collect and sale business model. All right, so there's a pattern which Costa can see over here. All right, any more responses? Anjali is saying it's hold to collect and sell Preeti is saying hold to collect, and the reason is also given by Preeti. Vaibhavi is saying entity holds the asset for collecting contractual cash flows. Stress case scenario will not reflect the business model. So let's again understand, go back to our discussion, because I think we've had a lot of discussion on this point now, and I would assume that you should be very, very clear on this part. So that's why I'm just taking you back to our discussions. So what do we need to check always? What's the objective? What's the business model of the entity? In this case, what's the business model? Hold to collect. Okay. I'm not saying, I'm not concluding, so I'm just explaining. It's hold to collect. So that's the objective. In certain scenarios, when there is stress, stress means when the entity is not able to recover at all. So what will they do? They will sell that particular financial asset to a third party so that they can recover and the entity could realize something out of it. But those are few and those are exceptions. Stress case scenario is not a regular thing. Those cases are exceptional. So that's why to say that because the assets are also sold, business model will change. No, that's not the model. That's not the objective. Entity doesn't want to have this objective. So the way they have been managing their portfolio is not by also selling. Number one. Number, even if they are checking the fair valuation, that's only in respect of those exceptional sales. By checking their fair value, they are not induced in a way. They are not just trying to sell it if those can be sold at a good pricing available in the market. That's not the objective. That is not what they have done in the market at all. Sale has taken place only in case of stress. So that's why just because these type of sales are arising, can we say the business model of the entity will also include sale of the financial assets? No. So that's why what should be the business model of this entity? Only this, hold to collect. Hold to collect. All right. Yeah. So that's the business model of this entity. So we can just continue with some more examples. So we can move on to illustration number 11 now. Let's move on to illustration number 11. This is page 12.70, illustration 11. Yeah, all based on whatever we have discussed. So be very careful when you answer this small one. Huh? Instrument G is a loan that pays inverse floating interest rate. That means interest rate has an inverse relationship to market interest rate. Can you analyze the nature of this cash flow? I think we discussed about it. Yes. Can you analyze the nature of this cash flow? Or in other words, do you think it will pass the test of contractual cash flows? I think very, very easy for you to answer. Yes, quickly. Yes, quickly. Chavi is saying no, sir, it will not qualify. Yes, that's true. Why? Because in this case, the interest rate has linkage to a point which will not be found in the basic lending arrangement. Clear? Yeah. Cost of as a query, cost of is saying, sir, in the last example, that means illustration number 6, it's given in the question that periodically the entity is making sales. So can we not say that there's a pattern involved? No. See, there's no pattern. Why I'm saying there's no pattern? Because what is a pattern? Pattern means something which will also kind of become regular activity. Let's understand this. See, during the year, in the given situation, that means if you look at the facts of this question, you are not sure whether the sale will take place or not. Is that correct? Because are you sure that during the year stress case scenario will arise? We are not sure. We are not sure. It may arise at the beginning of the year. It may arise at the end of the year. It may arise during the year, or it may not arise at all. So this is something which is exceptional. Again, you may question, but sir, how is it possible that for this entity, for none of its financial assets, it will arise? So we are not saying that practically it will not arise. Practically, it will definitely arise. During the year, at least for some financial assets, it will arise. But can we really establish a pattern? No, if we look at the full financial year. Secondly, even if those situations will arise, there are only few such exceptions. The model does not, the portfolio does not include many such financial assets which are getting sold because of this. Number 2. Number 3, the objective of the entity is also not to get into the sale. It's a sort of compulsion which is attached to them. Why? Because they get into that situation, they get bound by this. That's why you need to that's why you should not consider this to be a pattern. Now understood the point? Clear? Okay, so let's move on to next illustration. Illustration number 9. So this is again the same page 9. And I'm just marking 7, 10 also over here. So you just keep adding to your homework now, please. Illustration number 9. Instrument H is a perpetual instrument. Perpetual means there is no maturity period. But the issuer may call the instrument at any point and pay the holder the par amount plus the accrued interest due. Instrument H pays a market interest rate, but payment of interest cannot be made unless the issuer is able to remain solvent immediately afterwards. Deferred interest does not accrue additional interest. So if the interest is deferred, means it's not paid on time. So then additional interest will not be accrued because of this. You need to analyze the nature of cash flows. Or in other words, you can just simply say whether this instrument and whether these cash flows which are attached to this contract will pass the test or not. Yes, quickly. Yes, quickly. What do you think? I'm waiting for your answer now. Quickly. Pujita is saying it will not pass the test. All right. What about others? What about others? Will it pass the test or not pass the test? Yes, I'm waiting for responses now. So Vaibhavi is saying it will not pass the test. Preeti is saying it fails the test as it is not as per the basic lending arrangement. And can you also tell me, all of you, why you think it will fail the basic lending arrangement? Yes, any more responses from your side? Ashita is saying it will not pass the test. Kaustav is saying it does not pass the contractual cash flow test as not as, because this is not as per the basic. Okay, Rohita has a different answer. Rohita is saying this will pass the test. So it's interesting. If you can give me the reason also, Rohita, please. Any more responses? Then Neha is saying it will not pass. Fine. Gururaja is saying no. Again, he is saying because there may be cases of deferred interest payment on which interest is also not getting accrued. Very good. And that's the reason for this. See, in this case, there are cases, or there could be cases, which is specified in the question itself, wherein the interest may get deferred. And when the interest is getting deferred, ideally what should happen? Interest should also accrue on that. But they're saying no additional interest will be paid on that. No additional interest will be accrued. That's not something which will be in line with the basic lending arrangement. Yeah, clear on this? All of you? I'm hoping with this, all of you are clear. And I think I missed out adding one illustration, 8. And you may be thinking, oh God, so many illustrations. But just find all are small. I'm sure you can do that very easily. Okay? Yeah? Okay, so let's move further now. I'm hoping that you have written down your homework also. Reassessment of business model. So a reassessment of a business model may be required in case of a financial asset. Why? Because we have understood that it's all based on facts of the entity. If the facts will change, then the business model of an entity may also change. So let's see what is required to be done. An entity should reassess its business models at each reporting date. Each reporting date means, say at every reporting year, say at every 31st March, in case financial year is the reporting year for the entity, or you can say every reporting period, which could be a quarter period for some of the entities, depending on as to how they are structured. Reclassification of financial assets may be required when and only when an entity changes its business model. So what does it mean? It means if the business situation of change in the business model, because of which the reclassification will be required. Okay. Oh, so I understand there's some problem. Jay? This is all. So let's just quickly check with the students. So are you all able to see this live now? So I understand there was some buffering problem. Is it all fine? Can you please all confirm quickly? I'll go back to my discussion once you confirm. All of you quickly confirm. Is it all fine now? Yes. Please confirm quickly. Okay, great. Kaustav has confirmed. Pujita has also confirmed. Great. Yeah. Sure. So I'm just taking you back to our discussion on the change in the business model. So I'm not sure where did we lose. So I was talking about this third situation. I'm just revisiting this example now. Entity C is in the business of financial services with large retail domestic mortgage business. Now they have done strategic review, because of which they have decided to close their old business, and now they are commencing with a program, new business, wherein they will only sell the loans. So will we say it's a change in the business model? The answer is yes. Okay. Another example. Number 2, entity B. This one, I'm discussing this one. Entity B holds a portfolio of debt assets for trading and classifies them at fair value through P&L. Due to a severe financial crisis, the market in these assets disappears. So what will happen? Now the market is not there, so that means the new business model will have to come. So that's why it will again be considered to be a change in the business model. Okay, clear? Yeah. Okay, so now what we need is we need to go back to our categorization. If you go back to our categorization, there were 3 categories: amortized cost, fair value through OCI, fair value through P&L. For fair value through OCI and P&L, we discussed that every subsequent measurement will require fair valuation of such financial asset. So therein, the only thing that we need to do is every reporting date will fair value the financial asset. How the fair valuation will be done? That is, again, there are certain ways to do the fair valuation, which we discussed under Ind AS 113. You remember? But one thing which is new to us, amortized cost, is now important for us to understand. It's now time has come to understand what do we mean by this amortized cost, and how do we really measure any asset at amortized cost, or what is this accounting of amortized cost. So for this, I think we can look at one very simple example, yeah, which is there on the screen. So there's a security deposit for a lease which was given by one entity on 1st of April 12, and this will have a maturity period of 5 years. Okay. The deposit amount is 10 lakhs. Now we need to check how this will be measured. So what I can do is I can just note down these facts. This is 5th year, this is 4th year, this is 3rd year, this is 2nd year, this is 1st, and this is 0. So 10 lakhs is the amount which has been given today, and after 5 years it will be collected, it will be received back. So let's suppose A has given this deposit to B Limited. For A, it will be a financial asset, correct? And because this will be held till maturity, and the return will be SPPI, principal and or interest. So that's why this will be measured at amortized cost. Now the question arises, what do we mean by this amortized cost? How do we measure this amortized cost? What will be the accounting entries for those amortized cost measurement? Okay. For the purposes of measurement of this security deposit, there are 2 dates that we need to consider. First date is this date. When the deposit has been given by A to B, this date is called as initial recognition or measurement. Second date will be this year end, which is called as subsequent measurement. Okay. Now let's understand on the day 0, how will the measurement happen? On day 0, if you remember, we discussed every financial asset will have to be fair value. Yeah. So after 5 years, A Limited will receive 10 lakh from B Limited. You may be thinking, but sir, today also it's 10 lakh and after 5 years also it's 10 lakh. That's the arrangement. That's the arrangement. That's how arrangement works. So I'm just removing it from here. Now, we need to compute the fair value of the security deposit because this will be recorded today at its fair value. Correct? Now, what is this fair value? This fair value is nothing but its present value. Present value means that what will be the present value of this 10 lakh as on today. And again, one immediate thought which will come to your mind will be 10 lakhs only. You may say, sir, just only you mentioned it's 10 lakh and now you're saying what should be its value? It should be 10 lakh only. The answer is no. For this, you need to go back to our example. You remember time value of money we discussed, wherein we started with 1000, which became 1100 after a certain time period. Why did it become 1100? Because there's a time value of money. There's an interest component which is attached to this. Correct? There's a principle on which we need to work. What is that principle? That in this world, nothing comes free of cost. Okay. Now in this case, this security deposit has been given by A to B at 0% interest rate. In this case, interest rate is 0%, nil. But can we say that it is possible for A to give deposit, which is a kind of loan or which is a kind of fund to B Limited for 5 years and on which A will not earn anything? Not possible at all. It's not possible. And you may be thinking, but sir, that's the arrangement. That's the arrangement. There's no doubt about it. But within this arrangement, to say that A is not earning anything, or maybe B is not earning anything, or maybe that the commercial terms are like this, will not be correct. So what does it mean? It means, first of all, we need to check that if in the market, this amount or any amount would have been given by one party to another party, and after 5 years, 10 lakhs would have been collected by one party from the other party, what would have been that value today? That value today is known as present value. So what do we need to do? We need to compute its present value. Its present value today is nothing but its fair value. And for computing the present value, we need to apply our principles of those IRR. You remember internal rate of return, something at the inter level also you might have studied, something in financial management also you might have studied. That how do we compute the present value? This is the future value. So how do we compute the present value? We need one discount rate. Using the discount rate only, present value can be computed. Correct? Yeah. So in the question, discount rate has been given to us. It's 12%. Okay. If we discount this 10 lakh to today's date, how do we discount it? 1 divided by 1 plus r raised to the power n. You remember this formula, all of you? Yeah, I am hoping that you will be clear knowing this formula. This has got nothing to do with accounting. This is all about discounting. Yeah. What does this r represent? This discount rate. which is nothing but equivalent to internal rate of return. Okay. If we apply this principle using this rate of 12%, it would come out to 5,70,000. And the exact number is not 5,70,000. So I can just take you to the screen. Exact number is not 5,70,000. Exact number is 5,67,427. Okay. For the time being, for the purposes of our discussion only, I have kept that as 5,70,000. Yeah. So I'm just doing a sort of round off for the purposes of our discussion, because my focus is not to get onto the computation right now. My focus is onto the accounting right now. Okay. Now in this case, what do we do? Now in this case, on day 0, we need to pass an accounting entry. Accounting entry will have to be passed. So let's see, how do we pass that accounting entry? You can all note down this accounting entry. Huh? So we'll say security deposit debit 5,70,000. This is nothing but its present value. To bank. What will be the other accounting entry? To bank 10 lakh. Correct? To bank 10 lakh. Now where do we take the difference? Can we say that this difference is a loss? The answer is yes. Can we say it's a kind of loss? The answer is yes. Let's understand why. If a person gives 5,70,000 to somebody, then over a period of 5 years, if that person will earn interest at the rate 12%, then this amount will become equivalent to 10 lakh. Okay, yeah, that is how mathematics works. That is how this present valuation and future valuation works. But in our case, what has A Limited done? A Limited has given 10 lakh today and receiving also 10 lakh later on. So what are we trying to do? We are going beyond the legal form. We are looking at the substance now. So what does the substance says? Substance says that this person has actually given 5,70,000, against which he'll receive 10 lakh. And actually he has incurred a loss of 4,30,000 on this day itself. Means on day 0, he has incurred an expense. He has incurred a loss. Yeah, because this money he is not going to recover. Or if he is recovering this money, he is losing out on interest. So that's why it's a loss to him, isn't it? But because this loss pertains to a contract which is spread over a period of 5 years, that's why instead of taking this loss to P&L on day 0, what do? We amortize it over the period of 5 years. So we will call it as prepaid expense. And now instead of loss, why am I calling this as an expense? Because we are saying that actually if you look at the substance, A has incurred a cost of 4,30,000 for entering into this lease contract. A has entered into a lease contract with B. So this is the cost which A was required to incur for entering into this lease contract. Okay, clear? Clear on this? Clear on the accounting entry which will have to be done on day 0. So this is also called as initial recognition. Yeah, clear on this? Any questions from your side? Any doubts from your side? No? No? All right. So now this initial recognition is done. Now in the books of A, there are 2 assets which are appearing. What are those two assets? Security deposit of 5,70,000 and prepaid expense of 4,30,000. Okay, yeah. Now, Ind AS requires that this is a financial asset to be measured at amortized cost. So that means at every reporting date, this should be subsequently remeasured, or you can say this should be subsequently measured at amortized cost. Let's see how will that be done. Amortized cost means, or measurement at amortized cost means, that at the end of year 1, we should accrue interest on this, which is technically called as accrued interest on this. How do we do that? On this 5,70,000, 12% interest should be accreted, should be accrued, because that is what A Limited is earning. That's the substance which we have understood. Okay. So what do we do at the end of year 1 now? So let's see, on subsequent measurement, what do we do? We will book interest income in the books of A. How will that be booked? To finance income 70,000 into 12%. Yeah, so you can compute this amount and let me know what's the amount. 5,70,000 into 12%. Yeah. And what do we debit? Now, are we receiving this interest? Will A Limited receive this interest from B Limited? No. This is not getting received. So what will happen? This will get added to the value of the security deposit. So security deposit will be debited 5,70,000 into 12%. Okay. So this is the first entry which will be passed on year end 1. Other than this, there is another entry which will have to be passed. Let's understand that. This is prepaid expense. You remember, this is a prepaid expense. Yeah. Now we discussed that we will not charge this to P&L straight away on day 0. Instead, we will charge it over a period of 5 years, or we can say it will be amortized over a period of 5 years. So how do we do that? We will say expense debit to prepaid expense. And how do we compute it? Simple. 4,30,000 divided by 5. You can just compute the amount and let me know. So Costa is saying, sir, this one will be 68,400. So approximate amount we can use. Huh? And can you also tell me the amount for this? What will be the amount? 4,30,000 divided by 5. Yes, quickly. This amount also. Can you give me what's the amount? What's the amount for this? Quickly, huh? What's the amount for this? Yes, quickly, huh? What's the amount for this? Okay. Chavi is saying it's 86,000. Same is the response from Foster. Okay, 86,000. Now let's understand about the balance sheet position. So this has gone to P&L. This has gone to P&L. Correct? So these two are going to P&L. Yeah. This will go to balance sheet. And this will also go to balance sheet. So if you look at year end 1, what will happen? Value of security deposit will increase. And you will be thinking, sir, will we not take it to separate interest accrued? No. This will get added to the value of security deposit. deposit. So the value of security deposit at the end of year 1 will become now 5,70,000 plus 68,400 plus 68,400. Okay. And the value of prepaid expense at the end of year 1 will now become 4,30,000 minus 86,000. Yeah. And the same set of activities, same set of accounting entries will continue at the end of every year. Because of which, what will happen? Because of which, this prepaid expense at the end of 5th year will become 0. This will become 0, nil. Why? Because this will get fully amortized. Number 1. Number 2, next year when we will accrete interest, it will not be done on 5,70,000. It will be done on total of these two. Okay. Total of these two, which will again get added to the value of security deposit. So we are just accreting interest on the value of security deposit, because of which at the end of year 5, what will happen? Security deposit will become equivalent to 10 lakh. At the end of 5th year, security deposit will touch 10 lakh. And at the end of 5th year, other than these set of entries, another entry which will be passed will be, so I can just clear this part now. Bank debit to security deposit, 10 lakh, 10 lakh. Yeah. So at the end of 5th year, what will happen? Now the company, now A Limited will receive cash. So the account of security deposit will get closed. Yeah. Clear on this? Clear on this part? Clear on this part? Yeah. Any questions, any doubts, if in case you have on this, please let me know. We can just quickly discuss this. There are certain aspects of this accounting that we have not yet discussed. So I'll continue with my discussion on this aspect in tomorrow's session also. But any doubts around this concept that we have discussed, you may ask me. And we definitely have a detailed computation for this. So tomorrow, what we will do is, through the presentation, we'll run through all the numbers year on year with the accounting entries. All right. Yeah. So that complete computation also will do, because you may be thinking, but sir, can we not solve this for each and every year? Yes, we have that. So currently I have not taken you to that. Currently I've just tried to explain you the concept. So if you have any doubts, any questions on the concept around it, please let me know. It's very, very important. Why I'm saying it's very, very important? Because it's different. It's something new, which you have seen now, which did not exist under Indian GAAP. It's a completely new concept. So any questions, any doubts, in case you have on this, please let me know. Pujita is saying, no, sir, we are clear. Shall I say accounting as per amortization cost? That means this affects the deferred tax also as per Ind AS? Yes, of course. Because this accounting may not be accepted by income tax department. So what will happen? Temporary difference may arise. And I'll tell you why this will become temporary difference tomorrow. Because this is considered to be notional accounting. So tomorrow we'll understand why this is temporary. Yes. Any questions, any doubts? Kaustubh is clear on this. So if you don't have any doubts, then we can just close our discussion for now. Yeah. So tomorrow we'll continue with our discussion on this, and we'll also move further on the financial instruments. All right. Yeah. And in case you still have any query which you may not have discussed with me, you can just feel free to send your queries, and we can have a discussion on your queries tomorrow also. All right. Yeah. So with this, we can just conclude our discussion. Yeah. Okay. So thanks to all of you once again for your time and for your wonderful participation. And would request once again all of you to please send your feedback. So feedback forms, as I mentioned earlier, those are important for all of you. You should send your feedback. Okay. Yeah. Thanks so much.